Okay, in this section we're going to talk about using the buy and sell envelopes. In the introductory tape we went over some of these calculations, but I really didn't want at that time to get into how to use them. I want to stress that this particular section, using the envelopes, is not mutually exclusive with the gaps or on the volume percent that we're going to talk about later. Rather, it's something that you can integrate into your overall trading program. And there's a lot of ways to do this, and it's primarily support and resistance. And I recommend that you go to the market every day with these numbers before you, so you have a good idea about where the price is in terms of the general scheme of things and what you should be doing. So let's get started. I know some of these calculations can be a little tedious. Again, you can always refer to the book if you get confused on any of the calculations. So let's get started here. The sell envelope, and I want to go over some of these again, like I said, that I may have covered in the introductory tape, because there will be people who will be looking at this tape who didn't get that one. The sell envelope is an area where resistance should occur on the given day you're working with the market. One of the components of the sell envelope is the high of the day. Now, it's important that you understand that I'm thinking of doing these calculations after the close of trading. So if this is Tuesday afternoon, the high of the day, or what I sometimes refer to as the previous day, is the day just concluded, the trading day, that is. So if it's Tuesday afternoon after the close, the high of the day refers to the high on that day. We're going to use these numbers for Wednesday, the following trading day. So the high of the day is one area where resistance occurred. In other words, prices went up to a given price and stopped at that area. Tomorrow, the traders, especially the floor traders, will be looking at that price to see if it can get through there or not. Another component, the sell envelope, is what I call the trend reaction numbers, and here again it's a simple formula. High plus low plus close divided by 3 equals x. You double that, so that's 2x minus the high is a low or buy number, and 2x minus the low is a high or sell number. Now, unless the market's stationary, I'm not suggesting necessarily that you trade at these prices, only that at the low number there should be support, and at the high number there should be resistance. And as you see, we're going to average all these numbers to come up with yet a different number. The third component is the average of the last 3 rally numbers added to the day's low, again calculated after the close. So assume again it's Tuesday afternoon, the market's closed for the day, and we're doing these numbers for tomorrow, which is Wednesday. The rally is today's high minus the prior low. Again, if it's Tuesday afternoon, what was today's high? What was the prior low on Monday? So it's Monday's low to Tuesday's high. How far, in other words, did the market rally over this 2-day period? Not only this 2-day period, that would constitute one rally number. Then you have to go back Friday's low to Monday's high, Thursday's low to Friday's high. So you'll get 3 numbers, you'll average them, and that's how you get the rally numbers. The fourth and last component of the sell envelope is the average of the last 3 buying high, or what I call the second rally numbers, added to the day's high, again calculated after the close. The buying high is today's high to the prior day high. In other words, we're measuring high to high. How much did it exceed, today's high exceed yesterday's high? And if it didn't exceed it, we're going to give it a negative number if it was lower. So we'll see how that works too. And these are the 4 numbers that constitute the sell envelope. Buy envelope's a little different. It's the low of the day. In other words, today, what was the low of the day? Why did support come in at that area? Will it constitute support tomorrow? And there's a good chance it will. If that support can't hold, then maybe the market is indeed going lower. The second component is the trend reaction buy number, the high plus low plus close divided by 3 equals x. 2x minus the high will give you that number. So that's the second component of the buy envelope. The third is the average of the last three decline numbers subtracted from the prior day's high, again calculated after the close. In other words, how far down, on average, has the market traded from one day's high to the next day's low? We want to know this because tomorrow we want to have an idea of where the decline should stop, and we can use that information to trade. The decline is equal to the previous day's high minus today's low. Fourth component is the buy and under average, the average of the last three buy and under or second decline numbers subtracted from the day's low. So how much today did the market go lower than yesterday? It'll be a positive number if it was lower today. It'll be a negative number if today's low was higher than the previous day's low. And we do this over 3 days, Monday to Tuesday, Friday to Monday, Thursday to Friday. The buy and under is equal to the previous low minus today's low. And again, refer to the notebook if you have any questions on how to calculate these. Now, in addition to the sell envelope and the buy envelope, we then generate a sell number and a buy number. The sell number is this, the average of the four numbers in the sell envelope. So we have four of them now. We've got the day's high, the trend reaction sell, the rally, and the buying high. We have four numbers. We add up those four numbers, we divide by 4, we generate a fifth number, which we call the sell number. And at this point, we're not talking about how we use the numbers, we're just talking about the calculation of the numbers. The buy number is the average of the four numbers in the buy envelope, and they are, to summarize, the day's low, that's the prior day's low. By prior day, I mean if it's Tuesday after the close, that day's low. The trend reaction buy number, and you know how to calculate that. The average of the three declines, and the average of the three previous buying under numbers. As you'll see in a second, I put the sell number in the sell envelope. I put them in terms of the highest number to the lowest number. So some days the day's high will be the highest number. Other days it'll be the middle number, third or fourth. Now let's go on here. Here's an example of the sell envelope calculations. We're assuming these are S&P numbers, that the high, the low, and the close were as follows. The high is 337.70. The low is 335.15, and the close, of course, was in between at 336.15. Step one is to take the day's high. So you just write down the number, whatever it is. In this case, it's 337.70. You might take a pen and pencil here and write it down, and a pen and paper and write it down, and go follow me along on these calculations. Step two is you derive the trend reaction sell number. High plus low plus close divided by 3. In this case, we've taken the 3. I don't have to mention them all. We've added them up, we've divided by 3, and we generate a number. That is the X number. 2X, or twice that amount, will come to 672.70. Then we subtract the low to derive the trend reaction sell number. So the previous low, remember, was 335.15. We subtract that from 2X, and we indeed get a number which is 337 double, or 337.55. This will be one of the numbers in the sell envelope. Step 3, we derive the anticipated rally number. In other words, how far do we think the market will rally tomorrow? And we do this based on the last 3. So the day 1 rally, which was 3 days ago, was only 0.75. The The day 2 rally was 360, and this latest rally was 345. We add these up, we get 7.80, and we divide by 3, and we get 2.60. So this is how far we think the market's going to rally tomorrow. Now, to generate the number that's going to go in the envelope, we add that 2.60 to today's low, which was 335.15, and we get the number in red, which is 337.75. Another number for our sell envelope. Lastly, we have step 4, which is to derive the anticipated buying high number. We add the last 3 buying high numbers and divide by 3. So for the sake of our example here, I'm assuming that the first day buying high was a minus number. In other words, the high on the second day was lower than the previous day's high, so it's negative. It was minus 260. Second day, the market was also going down, so the high was lower, and that is minus 140. And on this past day, it slightly exceeded the high, so it's a positive number of 0.20. We add those 3 numbers, and we get minus 2.80. We divide them by 3 to average them, and we get a minus 1.25. This is how far, on average, below, in this case, we think tomorrow's high will be. And with that number, we take the day's high, and we add it. Now remember, when we're adding a negative number, it's going to be lower. So we take 337.70, we add the negative 125, and we get a number which is 336.45, or the number in red. This is going to be the 4th number in our cell envelope. Now we're going to put them all together as follows. And you can see I've listed them here from the highest to the lowest. The highest number in the envelope is 337.75, down on to the lowest number, which is 336.45. On subsequent days, they won't necessarily fall in this order. In other words, the day's high may be the highest number, and the trend reaction cell may be the lowest. It just so happens on this day, it came out like this. Now, you take the 4 cell numbers and you average them. You list them in a column, highest to lowest, and take the average price. This average price is known as the cell number itself, which is 337.35 in this case. Now, I'm getting a little ahead of myself, but I want to stress that I'm not saying that tomorrow's high will be this number. We've done numerous computer studies where we found out it's exceedingly hard to generate tomorrow's high and low, but it's not so hard to generate the range. And we're going to use this in a minute to see if we can create a range on what tomorrow will do, but it's easier to tell once the market's open. But at this point, just so we get our terminology correct, we have a cell number and we have a cell envelope. Now let's move on and do the same thing in the buys. And here again, we've derived the trend reaction buy number, which we've been through. We subtract the high from the 2x number, and it comes out to 335.00. Now we skipped a step here, so refer to the booklet if you're confused by this. Just for the sake of simplicity, I didn't think it was necessary to put all the numbers in here. Step 2 is we've derived the anticipated decline number. We've added the 3, we get 1435, we divide it by 3, and we get an average decline of 4.80. This means, on average, over the last 3 days, the market has trended down from one day's high to the next day's low, an average of 4.80. When we get in the market, you're going to find that this is very valuable information to have, and it sure beats trying to guess where the prices will go, because it gives us a ballpark figure on where we think we can stop, where the market will stop. What do we do with this number? We take the prior day's high. Now again, if it's Tuesday afternoon, we take the Tuesday's high, and we subtract this average decline of 4.80. So it's 337.70, which was the high, again assuming it's Tuesday. We take the average decline of 4.80, we subtract it, and we come up with 332.90. This is one of the numbers in the buy envelope. Moving on to step 4, we derive the anticipated buying under number. Buying under is a positive number when today's low is lower than the previous day's low. So the latest number will be day 3. Day 1, which is 3 days back, was 4.25 under. Day 2, the low was higher than the previous day, so it's a negative number, minus 0.35. Day 3 was also had a higher low, and it was minus 0.90. We come out with 300 divided by 3, of course, gives us 1 point. We now take today's low, 335.15. We subtract this buying under number, this average, and we get 334.15, the number in red. So we've now derived the anticipated buy under number.